Looking forward then to sort of 2019 as well, how much do earnings have to re-rate? What's the biggest risk?
We're simply in a global environment that's a little less friendly for risk assets right now. So just taking one step back, U.S. growth leadership has been the dominant economic narrative globally this year. And that's a risk in an environment where the U.S. is poised to decelerate going into 2019, and there's no obvious candidate to help pick up the slacks. The global growth environment is a little less friendly. What you'd want to see is the U.S. pushing forward at elevated levels. Unlikely, given that fiscal policy is, is peaking and monetary policy is tightening. And then you look elsewhere in the world and you don't see, you look at Europe, you look at China, you look at EM ex China, you don't see a lot of acceleration that gives you confidence that there'd be a bounce. So from the perspective of an investor, you have to look a little bit more in terms of relative value and a little bit less at the top line. So we look at things like the U.S. consumer as being relatively well supported as an aspect of the U.S. economy. Income has been growing vigorously. Part of that is the labor market. Part of that is wages growing and accelerating. So when we look at that part of the market and companies geared towards the U.S. consumer, I think we see a little bit more opportunity there. If anything, as we move our way through late cycle, that's something which should create a bit of a rotation from income at firms to households.
Does the drawdown of savings, personal savings, give you pause for concern? That in fact people are not having their wages increase fast enough to support the sort of consumer spending that's driving the economy?
Savings is a really interesting example. That's something we looked at a year ago as saying, well, actually one of the shock absorbers that households have to absorb a negative shock in earnings and keep spending is low. And then what ended up happening was sort of an arcane statistical exercise at the statistical agencies where they found more income on examination of the U.S. economy, and it turns out savings rates are actually higher than we thought they were. And so even if the trend is somewhat lower, they're coming off of a higher base, which makes us think that vulnerabilities are actually lower with respect to that type of shock. And so, they searched around the sofa, found enough change among the cushions to bolster income and increase savings rates.